Support for this podcast is provided by Avalara. Since 2004, Avalara's vision has been to harness the power of cloud technology to help simplify sales tax for businesses of all sizes, and their solutions are designed to affordably scale with businesses as they grow. Collecting tax for the government is something businesses just have to do, but getting the job done efficiently and correctly can be an incredible challenge because tax rules and regulations are endlessly complicated. Avalara keeps track of how thousands upon thousands of products are taxed in more than 13,000 tax jurisdictions, and that's just in the United States. And with more than 1,000 signed partner integrations, Avalara likely integrates with the ERP, e-commerce, mobile payment, and point-of-sale systems you use today. Find out how your business can be sales tax ready at avalara.com/taxnotes. That's avalara.com/taxnotes. Avalara, tax compliance done right.
Welcome to Tax Notes Talk, a podcast from Tax Notes, the leading source of tax news, information, and analysis.
Welcome to the podcast. I'm David Stewart, Editor-in-Chief of Tax Notes Today International. This week, so many bills, so little time. When we last checked in on Congress in August, at the top of the House's to-do list were two record-breaking bills, the $3.5 trillion budget bill and the $550 billion infrastructure bill. Since then, committees in the House and Senate have been working on the reconciliation bill, while the bipartisan infrastructure bill had been scheduled for a vote in the House this week, but that vote has yet to happen as of this recording on the morning of September 30th. On top of that, with the federal fiscal year coming to a close, this brings the need for funding to prevent a government shutdown. Oh, and there's a debt ceiling issue that could lead to a default without legislation to raise it. So how is Congress handling the increasing pressure to pass legislation, and where do the two big bills stand today? Here to talk about this are Tax Notes Capitol Hill reporters Doug Sword and Frederic Lee. Doug, Frederic, welcome back to the podcast.
Nice to be here, Dave.
Hello, thanks.
All right, to begin, there's been a gradual ramping up of tensions in Congress over the last couple months over an array of legislation. We've got the reconciliation bill, the infrastructure bill, the need to raise the debt ceiling, and potential government shutdown. So where do we stand today?
You're right, Congress has an awful lot on its plate, but they appear primed to remove at least one item from this jammed docket. It looks like the Senate will pass a continuing resolution today and that the House will quickly follow suit. As we speak, it's the morning of September 30th, and that's the last day of the federal fiscal year. So without a CR, as they're called, the government would partially shut down beginning tomorrow afternoon. Instead, they're going to kick the can down the road to December 3rd. And the continuing resolution covers all spending between now and December 3rd. And that's another deadline they'll have to hit because Congress has not successfully passed all of its 12 spending bills since 1996. So this is not unusual for them. Meanwhile, Treasury Secretary Janet Yellen told us this last week that the government runs out of money October 18th. After that, they can't fully meet the obligations. This is a condition otherwise known as default, which has never occurred before. So they'll have to do something in the next couple of weeks on that. And also today, the House is scheduled to vote on the bipartisan infrastructure framework. Whether that will happen is still up in the air. Progressives and moderates are tussling over this. Progressives want the infrastructure bill tied to their reconciliation bill. Moderates want to just move what is already there and already passed by the Senate. And what happens could well impact the chances for reconciliation.
Well, let's start with that infrastructure bill. It was passed by the Senate a month ago, and it was supposed to come up for a vote this week. What is in this bill?
Yeah, so the infrastructure bill is directed at exactly that. It's hard infrastructure, roads, bridges, and the like. In terms of pay for, part of the funding comes through ramped up reporting requirements for cryptocurrency, and another part's coming from the renewal of Superfund taxes, and that's an excise tax on several dozen chemicals that have been deemed hazardous. In terms of numbers, the crypto measure is expected to bring in about $28 billion over 10 years, and the excise tax measure a little bit less, so should be bringing in about $14.5 billion. Now, the infrastructure bill hasn't changed since the Senate passed it back in August. And the reason for that, there was a rule adopted by the House that blocked further amendments to the infrastructure bill not long after it passed in the Senate. So when that happened, hopes to amend the crypto provisions one way or another ended, basically, at least through amendment, which a lot of people saw as unfortunate because both those in the crypto sector and some lawmakers were really gunning to narrow the reporting requirements because of concerns that they were overbroad, especially regarding the word broker as it appeared in the bill text. Now, we have to look at Senator Cynthia Lummis. She's from Wyoming, Republican. She did say she wants a standalone piece of legislation to come to the Senate floor before the end of this year that would clearly define the term broker and other terms used in that space in the digital asset sector. I'm not sure if that's actually going to occur, but we're definitely going to be watching for it.
Now, there's been a lot of back and forth in the House over the infrastructure bill. What are the main conflicts that are delaying a vote?
Well, you mentioned that the infrastructure bill passed in the Senate a month ago. Well, there's this linking strategy that was used with the infrastructure in the reconciliation bills. It was established early on in the process by the House and Senate leadership, and that's definitely played a role in the timing of the infrastructure bill and why it's actually landing right now. A group of Democratic moderates, including Josh Gottheimer from New Jersey, a few weeks ago were pushing Nancy Pelosi to bring the bipartisan infrastructure package to the floor quickly after it passed the Senate, which led Pelosi to promise to bring the legislation to the floor by September 27th, which was this previous Monday. Pelosi came out and said that the bill would come for a vote on September 30th. House progressives have been saying in recent days that they'll actually vote against the smaller infrastructure bill without there being a vote on the more progressive reconciliation package. Now, on the moderate side, we have Stephanie Murphy, who's a moderate Democrat. She's in the House, from Florida. She said yesterday that if a scheduled vote on the infrastructure bill were to fail or be delayed, there would be a significant breach of trust. So it's high stakes. So what we're really looking at is prominent factions of the Democratic Party really digging in their heels at a time when the chance to get these two bills through is really, really starting to narrow. You have to remember that the Democratic Party coined itself as the Big Tent Party, so that's one way to look at it. Moderates are prioritizing the infrastructure bill while progressives are really backing the reconciliation bill. And that's a large reason why it's shaking out the way it is.
Support for this podcast is provided by SafeSend. Tax automation software is transforming the accounting profession. Support remote client relationships, enable collaboration, and reduce firm frustration. Experience the power of the SafeSend suite and improve your firm's process for client communication across the entire tax engagement. Schedule a demo at safesend.com to see it in action. That's safesend.com. All right, well, moving on to the reconciliation bill. The last time we spoke about it, this was a $3.5 trillion bill, but it seems to have gotten a smaller price tag since then. So what's the latest update there?
Moderates in both the House and the Senate, but particularly in the Senate, are holding up the bill. And that's because of the numbers. If you look at the Senate, there's 100 members in the Senate, 50 are Democrats, 50 are Republicans. For most legislation, it takes 60 votes to beat a filibuster, but the reconciliation is an exception to that, just like judges are. It only takes a simple majority. So 50 senators, along with Vice President Kamala Harris, can pass a reconciliation bill 51-50. But that means not a single Democrat can bolt from their party on a very controversial bill. Meanwhile, in the House, the majority is 220-212, which means if everybody shows up and Nancy Pelosi doesn't hold on to 4 of those people, the bill fails. And just last night, one of the Senate moderates, Joe Manchin, he's from West Virginia, he put out a statement reiterating what he said several times before, that he can't support $3.5 trillion. And he pointed out that Congress doesn't have a long-term funding plan to keep Social Security and Medicare afloat. And he just thinks it is, quote, fiscal insanity, unquote, to create new and expanded social programs. Basically, we don't know the number from the moderates, that they haven't said what they would go for. They have said that they want to roll back partially the Tax Cuts and Jobs Act, or at least Manchin has said that, but we don't have a number from them. And Democratic leaders acknowledge that the $3.5 trillion figure is something that's fading into the past. So the next couple of weeks of negotiation should be key in seeing what these numbers are.
So you mentioned Joe Manchin. Who are the other key players to keep an eye on during these negotiations?
Kirsten Sinema, she's a senator from Arizona. She's a freshman, and she has been probably the second most frequent moderate voice on the Senate side objecting to the size of this package. And over in the House, it's Josh Gottheimer from New Jersey, who was the head of that 9 moderate coalition that insisted on a vote on the infrastructure package. And then there's Stephanie Murphy. She's the co-chair of the Blue Dog Coalition, fiscally conservative Democrats, and she was the only member of Ways and Means to vote against their 1,900-page tax package back on September 15th. And then there's leadership, House Ways and Means Chair Richie Neal, who is really enjoying pointing out that he has the only active piece of legislation out there, the 1,900 pages I just mentioned, that he believes will be the basis for negotiations going forward. And he's very much in lockstep with House Speaker Nancy Pelosi. Over on the Senate, there's Senate Finance Chairman Ron Wyden, who has put out hundreds of pages of legislative text over the last few months on international tax regimes and repealing carried interest and a lot of other things. And he's looking to get a lot of that into the bill. And his partner over in the Senate would both be Majority Leader Chuck Schumer and Senate Budget Chair Bernie Sanders. But increasingly, it's Joe Biden. Biden had been the big player early on, since most of this package comes out of his tax proposals from the campaign. But he'd been quiet in recent months. But in the last week, he's met a couple of times at least with Sinema and Manchin, and he's met with Gottheimer and Murphy and other moderates and with the progressives. And he's trying to get them to start talking about an actual number, because it's really impossible to negotiate when nobody will say what their number is.
Now, you mentioned the chair of the Ways and Means Committee and the work that committee has been doing on the tax provisions of this bill. Could you tell us about the important pieces of that?
Sure. What is now moving through the House is this massive reconciliation bill. It's all been put together. It's almost 2,500 pages. Now, almost 1,900 of that came from Ways and Means. So this is very much a tax and revenue bill. If you look through the Joint Committee of Taxation scoring of this, they have really scrunched up type, and it's 12 pages, and there's more than 140 separate scored tax provisions. So I'm going to mention some of the biggest tax increases. First is the big one, increasing the corporate income tax rate from 21% to 26.5%. That's $540 billion over 10 years. That is the one that people are focusing on the most. There's also a bunch that are 100 billion or more, in some cases quite a bit more. There's the increasing the individual top marginal tax rate from 37% to 39.6%. There's increasing the top capital gains rate from 20% to 25%. There's a 3% surcharge on incomes over $5 million. And there's changes to all those international acronyms, GILTI, BEAT, and FDII, basically overhauling the international tax regime to bring in several $100 billion. These are all over 10 years, by the way. And there's also a change to the net investment income tax, known as the NIT, where they will apply the NIT to certain incomes of high-income households. And then they would make permanent the excess business losses limitation. So the owners of pass-through businesses couldn't write off as much of their losses as they could. One that isn't over 100 billion, but I'm going to mention it anyway. They're going to double the taxes on tobacco and place a tax on vape products. And that comes out to very close to $100 billion, I think about 98 maybe. Then there are the tax cuts. The biggest part of the tax cut package is $835 billion for social safety net tax cuts. And that is mainly the child tax credit expansion that was in the American Rescue Plan in March, that boosted the child tax credit to $3,600 for over the year for children under 6 and $3,000 for those under 18. But there's also increases in the earned income tax credit, the child and development care tax credit, and there's some sizable new caregiver tax credits. There's also a big group of green energy tax credits amounting to over $200 billion. And in that is a renewal of the tax credit for electric vehicles, which had been $7,500, but it will be $12,500 if this bill passes. And that's a little controversial because $4,000 of that is if the car was made by union workers in a union plant. So Republicans aren't too thrilled with that provision. Then there's over $100 billion of housing tax credits. There's rehabilitation tax credits and a big expansion of the low-income housing tax credit.
Now, another option to pay for this reconciliation bill is new bank reporting requirement. Could you give some background on the bank reporting requirements and what they look like?
Sure. This is another White House proposal. A large portion of what the White House wanted to use to pay for a reconciliation was increased tax collections at the Internal Revenue Service. Now, they were looking at about $300 billion in tax collection increases by boosting the IRS budget. The IRS budget has been pretty flat for about 10 years. They've lost an awful lot of their auditing and enforcement muscle, and President Biden wants to build them up again. But an even bigger portion, even bigger payday on tax collections would be over $400 billion by instituting a new bank reporting requirement. This would in effect be a 1099 for everything that goes in and out of your bank accounts. And that's because there's a tax gap between what people pay and what people are supposed to pay. It's estimated to be $700-800 billion a year. And there's very high compliance for people who have wage income because there's third-party reporting. Their employer tells the IRS how much they make. There's third-party verification on dividend and interest income, but there's no third-party verification largely on business income. Businesses fill out their tax returns, and what the White House wants, they want their banks to report their gross inflows and gross outflows each year to see if that adds up to what they're reporting in income. Now, this was not included in the Ways and Means bill. The $600 threshold was too low for Richie Neal's taste. There's a lot of talk about what that should be and what all may or may not have to be reported. And this has become a big issue for Republicans because they consider it to be very invasive. It's caught fire at the grassroots. There's an awful lot of complaints coming from not just Republicans, but the people who are worried about the data collection here.
In addition to these two record-breaking bills, there's also the prospect of a government shutdown without additional funding. So what is Congress doing to prevent that from happening?
So Senate Majority Leader Chuck Schumer announced yesterday that Democrats and Republicans had come to an agreement on a CR. So that's a continuing resolution that would avert a government shutdown. And they're voting on it today. So it's expected that the House would take up the CR once the Senate has passed it. So in terms of the reconciliation and infrastructure bills, the shutdown is really another straw on the camel's back, complicating all of these other items, sort of like the debt ceiling. Now, the debt ceiling and a looming government shutdown are related, but in my mind, the debt ceiling really is a larger issue because of risk of the United States defaulting. That would be the first time that ever happened in our nation's history. There's a sense that taking care of these issues, debt ceiling and the government funding measure might clear the deck for these other two bills.
All right, well, thank you for being here, and we look forward to having you back when we know how all this shakes out.
Thanks for having us, and it's going to be interesting to see how it shakes out.
Thank you very much.
And now, coming attractions. Each week we highlight new and interesting commentary in our magazines. Joining me now is Acquisitions and Engagement Editor-in-Chief Paige Jones. Paige, what will you have for us?
Thanks, Dave. We are excited to announce that the winner of the 2021 Christopher E. Bergen Award for Excellence in Writing is Bailey Hands. Bailey's paper, titled GoFundMe, The Gift That Keeps on Giving, all tax season long, examines the tax consequences of donations made through crowdfunding platforms and explores ways to provide certainty to donors and donees in the absence of administrative or congressional tax guidance. Her paper can be found in this week's edition of Tax Notes Federal, State, and International. And Sadi Moradi received an honorable mention for his submission. Congratulations to Bailey and Sadi. Also in Tax Notes Federal, Paul Carman examines the terms commodities, securities, money, and foreign currency in relation to the tax treatment of cryptocurrency, and he argues that they should be subject to consistent definition and usage throughout the IRC. Thomas Nichols examines the effective repeal of Section 199 Cap A for large pass-through enterprises, as well as estates and trusts. In Tax Notes International, Mark Quacooper examines a case involving the Belgian tax authorities' denial of a deduction for a reversal of write-downs that the taxpayer recorded before transferring to Belgium from Luxembourg. Steve Suarez analyzes the Federal Court of Canada's recent judgment in Dean's Knight, which addressed the tax treatment of non-capital losses and other tax deductions under Canada's anti-avoidance rules. In featured analysis, Carrie Brandon Elliott examines the treatment of 25% owned domestic subsidiaries in determining passive foreign investment company status, along with anti-abuse rules and proposed safe harbors. On the opinions page, Benjamin Willis and Jed Bodger make predictions for tax legislation, focusing on taxing income through realization at death and the elimination of Section 1014's basis step-up. And now, for a closer look at what's new and noteworthy in our magazines, here is Tax Notes State Editor-in-Chief Jan Rausch-Sender.
Thank you, Paige. I'm here with Lynn Gandy, partner and business lawyer with Foley and Lardner, and a member of the Tax Notes State Advisory Board. Welcome to the podcast, Lynn.
Thank you for having me.
Let's chat about your recent Tax Note State article, Zelensky, round 2 of the convenience of the employer test. Would you provide listeners with a summary of your article?
I'd be glad to. The article began when I happened to come across Professor Zelensky's latest filing in New York tax appeals regarding a petition for his 2019 year, where again, Professor Zelensky was raising constitutional challenges to the New York convenience of the employer test. Now, I do not practice in New York. I have lived in Connecticut, so I've been close to New York, but almost everyone has become a quasi New York knowledgeable about the convenience of the employer test due to the pandemic and the implementation by other states, such as Massachusetts or the state of Ohio for its municipal tax, on these remote work convenience of the employer rules. So when I saw the petition, 2 things immediately sparked my mind. Number one, we know this remote work is here to stay. We know it's being used as a recruitment tool. How is the convenience of the employer rule really going to be applied going forward? But also, how is it going to be applied during COVID? That's when we had a number of challenges, particularly the New Hampshire v. Massachusetts case. And then secondly, and I almost hate to admit this, I was surprised that Professor Zelensky was still with us. And I hope Ed is listening to this. I'm very delightful that he is still with us, but that he was still very active in these petitions. So that was the genesis of the article. I decided to name it Zelensky Round 2 because it is not that often where you get a case brought by the same pro se plaintiff on an issue that was litigated before at the New York Appellate Court, which is their highest level of judicial proceedings in New York State. But it's also a case that I teach to my students at my alma mater, Wayne State University Law School, in my state and local class. So it's kind of exciting to see, once again, a case that you teach to your students and you try to make it applicable to today, to have it come alive again with same plaintiff, same defendant, same issue, but what a different set of facts we have going on today.
So, Lynn, would you say that essentially this new work from anywhere or COVID, the pandemic, spurred this article?
I would say it definitely helped. As everyone is aware, particularly with the denial of the petition by New Hampshire in a case of original jurisdiction before the U.S. Supreme Court, this issue of when you are working from a state different than your assigned location or even your residence, how is that going to be taxed by the state? And it's very multi-layered. The first question that I'm sure many of my colleagues had raised to them early on in the pandemic, when we were in the mid to late 2020, was, what do I do about my employees? Like, where do I withhold taxes? So the first level, I like to call it, is the employer compliance administrative. Where do I report payroll? Where do I have to do withholding? And as our pandemic and crisis extended, where states still had mandated work from home rules in place, Michigan being one of them, then we had a great deal of questions from clients. What do I do now for 2021? And what became apparent was many companies, unless you had foreign workers or you had people who traveled on a very regular basis, where they would geocode their time when inputting their time, or for foreign workers who needed work visas, a lot of employers had no idea where their employees even were. You sent everyone home, but how do you know if they're on the beach in Hawaii or in a ski chalet in Colorado? And there, the problems then multiply for employers again: city taxes, business registration taxes, gross receipts taxes, all those taxes, not protected from like any type of public law 86 to 72, even if the employees were engaged in solicitation, which most of them are not. They're back office employees, and now they have their location now in a different state. And if you are an employer and you do know, is that a tacit acknowledgement that indeed you now do have a form of nexus, physical presence in the state? The second layer, which again, we all had a lot of questions on, is what about the employee? Where do they pay their taxes. And many, many employees are not used to the concept that your home state, most likely the general scheme, taxes 100% of your global income. And if you're working in another state, a state where you're a non-resident, that state's entitled to tax the income earned in that state. So many employees were not used to the idea. And by the way, they have to tax the income that you earned in that state, and your home state gives you a credit for taxes paid. So that's a whole other host of issues. Employees were not used to this concept that they might have to file multiple state tax returns. They did not understand the credit regime. If you're resident in an income tax-free state, what does that mean if you are working part-time in a state that does have an income tax? You get a credit for what? Because you have nothing to apply the credit to, or vice versa. They're working in Florida. They don't understand why they have to pay taxes on their global income if it's not taxed elsewhere, because there is no credit. So a lot of inconsistencies in the credit regime, let alone we haven't even touched upon. What's the impact to the employer on their payroll factor for those 22 or so states that still have a payroll factor? What about all your incentive agreements or workforce development agreements where you committed to have a certain level of payroll or employees in a state? So it quickly became clear that at this point, state tax practitioners were going to have to pivot a little and become labor and employment lawyers as well. Luckily, at Foley, we have a great group of labor and employment lawyers. I didn't have to learn that side of the law, but I developed some close relationships with some of my Foley colleagues, all of whom I have met primarily remotely, particularly our labor and employment lawyers, because we had clients that needed to start moving people around. What did it mean for tax compliance? And then what did it mean for corporate income tax? So there's no doubt that these are the issues of the 22nd century, because we've seen this recruitment tool of work from anywhere. I mean, I'll do a little Carmack crystal ball here. I think work from anywhere at some point will lose its flavor of the day attractiveness, particularly I think when companies who are not used to having US-wide reporting requirements start to realize the administrative burden and cost of, let's say, 35 state, not just income tax withholding, W-2 processing, you have local taxes, you have state unemployment insurance. Don't forget, again, my friends in labor and employment have taught me benefit packages. You know, you could have an employee that you didn't know is now completely out of network on your medical plan. You have one employee in the state. Now you have to join another one. You have to set up a network in that state to get lower costs of medical care coverage for your employee. So I think it's really expensive unless you're set up and truly understand the administrative burden. But let's just go back to Mr. Zelensky, because there's a couple little teasers in the article I want to make sure the listeners don't lose. Interestingly, Professor Zelensky's tax year at issue in this Zelensky round 2 is 2019. While it may seem like it's been a real long time, 19 was even pre-pandemic. So his article is really attacking the year prior to the pandemic. And I think the arguments are strong, particularly from an external consistency argument. But if we look at the pandemic, New York put out some guidance, as did many states that initially just said, we won't treat your remote workers in our state as a physical presence for the business in the state during this very unsettled times of, mandated work closures. But no one really expected that to go on as long as it did. And it did. But what I think states and cities did not expect was it to change how we work. So a lot of that interim guidance, which was just that, was guidance. Very few states actually changed rules or passed regulations. That has now gone by the wayside because we're not in a mandated work from home. And so what does this mean for this test convenience of the employer, which I just personally believe is very artificial? It is a concept used in federal unemployment, and many state unemployment regimes follow it. In other words, what state would pay you benefits? Let's say you're a traveling salesman. It is the state of your home assigned work location that you would apply for unemployment benefits. But when we get into income tax or even business activity tax, those concepts are just too kind of stilted in old world. And if we follow New York's interim guidance, they end up in a circle where they said, well, we'll count it as a day out of the state if your employer made you go work there. Well, of course, your employer made you go work from home. If you're Professor Zelinsky in Connecticut, they mandated you couldn't come to the office. But then now what does that mean? Then New York, what does that mean now when you're still at home? Because your school or university might say, for health reasons, we want to limit class size. Or we're going to rotate in class sections, again, for health and safety and to reduce density. Or what happens if his employer says, you know what, the Zoom worked out so well, we're going to open up a remote learning opportunity for students around the world. And Professor Zelinsky, you now don't have to work here. Then New York issues guidance that says, well, in that case, your home office only counts as an out-of-state office if your employer has gone through some affirmative steps to set up a satellite office within your home. I think the guidance is circular. It really looks desperate. So I think the biggest question in Zelinsky round 2 is if they uphold the test and they uphold the external consistency test, how are they then going to grapple with it when it is the COVID era? And it might not be Zelinsky round 3. It could be another employer files. It could be another employee files who perhaps has already received an assessment or perhaps has filed a claim for refund. So more to come.
It's a wonderful article, and I'm so excited for the readers. Before I let you go, where can listeners find you online?
Online, you can find me, of course, at lgandy@foley.com. You can find me on the Foley website, and you can also find me on Instagram at Tax Goddess. That's 2 X's, 2 D's, and 2 S's.
Thank you so much for joining me today, Lynn. It's been a real pleasure.
Thank you.
You can find Lynn's article online at taxnotes.com, and be sure to subscribe to our YouTube channel, Tax Analysts, for more in-depth discussions on what's new and noteworthy in tax notes. Again, that's Tax Analysts with an S. Back to you, Dave.
That's it for this week. You can follow me online at TaxStew, that's STEW, and be sure to follow at Tax Notes for all things tax. If you have any comments, questions, or suggestions for a future episode, you can email us at podcast@taxanalyst.org. And as always, if you like what we're doing here, please leave a rating or review wherever you download this podcast. We'll be back next week with another episode of Tax Notes Talk.
Tax Notes Talk is a production of Tax Notes. You can learn more about us by visiting www.taxnotes.com/podcast. When major media wants the straight story, they turn to Tax Notes. Thank you for listening, and join us again for another edition of Tax Notes Talk.
For the last few months, frequent guest of the podcast, Tax Notes legal reporter Ryan Finley, and I have been working on something special. And now we're ready to show it to everyone. We designed the Tax Notes Transfer Pricing Center as a one-stop shop for transfer pricing news, rules, and guidance from the OECD, US, UN, and around the world. On the OECD page, you'll find a comprehensive topic index that will take you directly to the OECD guidelines section you're looking for. On the US page, you'll find a digest of important court cases with summaries and links to key documents and related cases. And while you're looking around, check out the OECD US comparison table to quickly reference related topics. And everywhere you go in the Tax Notes Transfer Pricing Center, you'll find convenient links to news and commentary from all of the talented writers here at Tax Notes, Ryan Finley very much included. To check it out today, go to taxnotes.com/transferpricing. That's taxnotes.com/transferpricing. Want more like this? Subscribe for more tax videos. Special thanks to our executive producers Jasper Smith and Paige Jones, showrunner and audio engineer Jordan Parrish, and guest relations coordinator Christa Goad.